It is March the 3rd. Michael Vaughn with Brian Acker. Brian, how did February go?
Very strong markets, equity markets, all this central bank activity, everyone easing all around the world are pushing up asset values.
Yes.
So here in the U.S., we're up almost 8% so far this year. We are lagging the U.S. a bit by about 3.5 percentage points, so hopefully we make that up during the year. And the same thing in Canada. We're up almost 3% there, and we're a little over 2% behind the index.
What an anniversary is coming up in just a few days from now.
Yeah.
You remember, well, you remember so well.
On March 9th,
Yep.
2009, we're fast approaching the anniversary of that date, which is actually the low in the marketplace after the crash of 2007, 2008. And so on our front page of our website, you can actually see literally what we have done 6 years ago in terms of returns up until yesterday. So our fund is up 350% from the bottom, or from March 2nd going back to 2009, and the S&P in Canadian dollars with total rate of return up about 2.25%. So why
Stay
did
invested, don't time the market.
very good, and I actually have a blog, 10 lessons I've learned, certainly in this past crash of 07, 08, that I learned from the crash of 87 and certainly the crash of the tech crash of 99, 2000. So,
Can this continue in what I would call a deflationary environment?
Well, first of all, the central bank activity is off the charts. I think we've had 16 separate actions from different countries in January alone. February, even on Saturday, we've had Friday night, Saturday, we have even the Chinese easing for the second time in 4 months.
Yeah.
So central bank activity wants higher asset prices around the globe. This is what's happening, and this is basically the effect that you're seeing. But as I are now saying to clients is, we don't know when, or timing is very, very difficult, but there seems to be a cold hand of deflation that appears out of nowhere to push bond yields lower and has an impact on equity values. Then you see the cycle again on the central bank activity.
Well, the bonds, I don't understand. If I want to put my money in a Swiss bank, they charge me money now.
There's now, thanks to Zero Hedge, the website, there's now about $13 trillion worth of bonds that are actually yielding negative interest rates. So, rumor has it, all central banks all over the world are making sure systems are in place for negative interest rates.
Yeah.
So the systems can handle it, the computer systems, the banking system, etc. So is this huge amounts of surplus capital looking for a home and driving down rates to such an extent, or is it a manifestation of currencies? In other words, everyone's trying to devalue relative to the US dollar. We made that US dollar call 2 years ago, but again, everyone, including Canada, is trying to lower the currency to get growth relative to the US dollar, and they'll do it that anyway. And what's happening is a lot of these countries are having negative interest rates, certainly for the first time in modern finance, and it would be interesting to see what happens. We've got a huge cohort of baby boomers, certainly in the retirement years, are coming to retirement, and
Terrified of risk.
10-year Government of Canada bonds are 1.28% as of this morning. I did a blog on the calculation of how much capital you need in order to get $100,000 of interest income in Canada, and it's a staggering amount of capital. Who has that amount of capital? I'm not sure, just to get that 100,000. So interest rates, I marvel at every day. And who's to say interest rates won't go negative in Canada? But if it does, I mean, financial planning, certainly for retirement, will be a very interesting topic.
Well, it is central bank activity. It is trying to bring currencies down, but is it not just a terrible, cyclical, generational fear of all risk?
There are so many things coming together here. Huge amounts of capital looking for a home, looking for any sort of rate of return. You've got a generation of baby boomers, again, all over the world. Demographics are having a huge impact, not only on savings rate, but actually growth itself. It's certainly research indicates that certainly as we get older, we spend less. So again, all that economic growth, if you will slow down, certainly in the older economy, so just on the demography side. So we're in interesting times, we always seem to be, but equity markets are pushing higher, shrugging off all these risks. The central banks want higher assets, certainly in terms of valuation, and that's what's happening. So we have to stay tuned.
Aging boomer though I am, I think I'll stay in the S&P a little longer. Thanks for your time, Brian. I will be in to see you in a month.
Michael, always a pleasure. Thank you.